Hey everyone, welcome to episode 35 in my monthly series where I'll give you a quick commentary on the overall stock market this past month and review, of course, some of the most popular high yield income oriented funds on both the Canadian and the US stock market to see how they're doing and, of course, which ones I feel are a good buy for the next month. If you're new to the channel, welcome. This channel and my investing strategy really focuses on a long-term buy and hold income oriented or income focused strategy. So the primary objective of the strategy is really to generate relatively safe, consistent, passive income forever. And one important factor of my strategy is that you keep investing over time on a monthly basis if possible. So you could always dollar cost average and capture what is undervalued in the stock market, right? So I do not invest in single stocks or single companies anymore, with some minor exceptions there. So all my stock picks will pretty much be funds, everyone, either ETFs or closed-end funds that are really designed to provide high yield and passive income. They are essentially income oriented, not growth oriented. So most, if not all of them, have income enhancing strategies like covered calls or leverage, and sometimes both. So remember that I am not against the more mainstream growth or dividend styles of investing. I think all three styles work very well long term. Whereas, my strategy is really designed for income, and those strategies are really designed for total growth. So now it's time to check out how the market's been doing in the last month. All right, everyone, let's take a look at what the market did in the last 30 days, in the last month. I am filming this, by the way, on the weekend, on the 4th of February. So the last month was actually pretty good for the S&P 500, especially lately. I mean, tech stocks kind of rallied, which definitely helps the American stock market overall because it's very tech heavy. So up 7.36% in the last month, pretty good. Canadian one was up too, not as much though, which is, normal because it's more materials focus, materials and energy. So typically when tech stocks do really well, gold producers and materials don't do as well. So Canada is still good, still up just under 6%. And of course, the big news is still the inflation. So both the Bank of Canada and the Fed, the American central bank, raised interest rates by 0.25%. So they're slowing down, which means inflation is actually going lower. So it's going to take some time, but the markets have gone up probably because of that. That inflation is calming down. So let's look at the overall high yield Canadian landscape. As usual, we'll start with the Canadian landscape and then we'll go with the American landscape in terms of my top or what I feel are the top high yield funds out there. So of course, first we're going to go with the big four or the big five in Canada: H-Yield, HDIV, and BMAX, as well as EIT. These are staples, what I feel are great foundational ETFs to have. So H-Yield still going strong. Not really anything much to cover. They did, rebalance, or, it's a little bit updated here. So you actually see JEPI and JEPQ as 15% each here, just trailing QYLD, which is still the top position. So yeah, again, excellent fund composition here. You have what I feel are, in my opinion, the top 5 covered call ETFs, or most popular ones in the US altogether. All index based, guys. S&P 500 for XYLD and JEPI, and of course NASDAQ 100 for JEPQ and QYLD, and then you have your small to mid cap with RYLD, and a nice little stabilizer. The rest, or 25%, is pretty much in gold producers, healthcare. So the gold producers is kind of like a hedge. You'll notice that whenever the overall American market does well, typically gold producers go down, and the opposite is true, right? So GLCC has been a nice little hedge, which I really like. I think it's really smart. You add extra healthcare here for additional defense, and they added NXF, a tad of energy, because it didn't have much energy. So still going strong. It is growing very, very quickly. Very, very popular fund, almost 400 million now. No news when it comes to the dividends. They've stayed relatively stable at 14 cents. So definitely still a good pickup if you ask me. This will capture the entire American stock market. You have HDIV, the twin brother or sister, which follows more the American stock market, still completely destroying or beating the S&P TSX 60, which is kind of like the S&P 500 of Canada, by over 4% annualized. And the big news with HDIV, of course, is a big 8% dividend increase, 13.5 cents instead of 12.5 cents. And they added their new Canadian Financials Yield Maximizer ETF, HMAX, in here. and sold off a little bit of ZWB. So will they sell off ZWB completely for HMAX? My opinion, I think that would be a good idea. Why not? It's pretty much the same thing. The banks or financials with covered calls. But hey, even if they have, ZWB in there, a little position, I don't mind it. But what I really love about HDIV now is you have the Jekyll and Hyde and the yin and yang when it comes to Canadian financials with HFIN and HMAX. So HMAX is literally maximum income and HFIN is maximum growth because there's a bit of leverage here. There's 25% leverage, no covered calls in HFIN. And here there's no leverage but maximum income or very aggressive covered call. So you literally have the best of both worlds together. It's awesome. I think it's a great thing to add HMAX. And, check out my HMAX video if you haven't seen it, where I go over the ETF in detail. Of course, this is a big deal. It's a brand new covered call ETF that focuses on especially the Canadian banks, but it's diversified financials by Hamilton, one of my favorite ETF providers, of course. Moving on to HDIF, another one of my favorite funds, one of my favorite ETF providers as well, Harvest. So HDIF, as we know, just takes Harvest's 6 most popular covered call ETFs, puts them together, and puts 25% leverage. So it's been doing really, really, well, just hovering around that 10% yield right now. The distributions, or the first distribution has been declared for 2023. It remains unchanged. And this is typical Harvest, right? The distributions are very, very, very consistent. Just the reason why I like them. Amongst other things, of course. And the fourth and most brand new all-in-one is, of course, BMAX from Brompton, which is hovering at over 9% yield right now, and not much news here except that they did declare another set of quarterly distributions. So these guys are going to probably announce 3 distributions at a time or quarterly, and it's remained unchanged at 10 cents. Of course, the last but not least when it comes to the big 5 is EIT, Canoe Income Fund. Still the king, always the king, always trading at a tiny discount. You see it's worth $13.70. It's trading at $13.61. So not much to report here, guys. When it comes to BMO, they did launch 2 brand new covered call ETFs, a healthcare one and an energy one, which if you haven't caught it, I discussed it with them on their YouTube channel, ETF Market Insights. I was a guest host there again. Make sure to check it out. So we talk about these 2 new ETFs. So now they literally have no excuse. They have everything they need to do in all-in-one. We discussed that as well. So I personally don't know if an all-in-one is coming. I think so. I think an ETF all-in-one covered call solution is coming from BMO, but it seems to me like they don't really like leverage. So unfortunately, we're probably not going to get a leveraged version, but I'll keep trying to change your mind, guys. Moving on to closed-end funds. Now we're going to check out the Brompton split share funds. So they're all trading, except the life insurance one, which actually passed $15 unit NAV. So 16% yield, and it's actually trading at a discount. You see here that LCS is worth $580. I'm talking about the Class A shares, of course, but you could buy for $547. So this one is not one I would recommend. But hey, if you're feeling lucky and you really, really believe in life insurance companies, all this has is the 4 life insurance companies in Canada. So Sun Life, Manulife, Great-West Life, and IA Financial. You could go for it, but they missed a lot of dividends in the past, so it's not one that I would recommend. Looking over the other ones, the ones I like a lot more would be GDV and DGS. They're trading at high premium, so they don't really stand out to me. SBC trading at a premium, about 16% premium, but LBS is the one that really looks attractive to me right now. It's trading only at a 7.9% premium, guys, and this is because they had an overnight offering recently. So you see here it's worth $836, but you could get it for $902. It's only trading at a 8% premium, and you'll get 13.30% yield. Pretty good. This is the one that really stands out to me in Brompton. PWI, okay, it's trading at a 10% premium. It's pretty low as well, but my opinion, if you're interested in PWI, you might as well go with BMAX. That's just my opinion. Let's look at the Quadravest ones now. Of course, the ones I cover there are 3 more popular ones: DFN, FTN, BK. But if you take a little bit more risk and you like the Dividend, the DF, or the FFN, you'll have to look them up yourself. So DFN, they just updated. I always wait till Quadravest updates their NAVs before I do these videos. That's why I had to wait till the 4th of February, or else I would have unveiled, did the picks video earlier. But 1621, that is the unit NAV, everyone. So subtract 10 takes away the preferred shares, and the NAV of the Class A shares are about 16.21. So it's trading for 780, which means it's at a 25% premium. So Dividend 15 is trading too much of a big premium, in my opinion, to be attractive right now. The most attractive one is still FTN, everyone. So 857 NAV for the Class A shares, and you could pick them up for 968. So FTN, you're looking at a 13% premium. So, you know, under 15% is kind of attractive for me. So LBS and FTN, definitely the two split funds that stand out to me that have good value. BK is at a 20% premium. So 20%, and when it becomes too high for me personally, you see it's going to be worth about 11.36 and you have to pay 13.64. Moving on to Middlefield. So this is where you have probably the split share fund value of the month is going to be with RS. You see here that the closing price is 15. It's actually a lot higher because it popped on Friday a little bit. So this is from February 2nd, but you know, we'll have to wait. They typically update them every couple of days. They update them very quickly. So RS, everyone, is definitely my split fund pick for February in terms of value. Okay, in terms of value. So if you want to add more real estate, if you're looking for real estate, you know RS is my number one choice, and you see it right here, guys, that this market price and the NAV are very, very, very close. So it's very, very rare that RS is trading, you know, pretty much on par, the NAV with the stock price. ENS announced a 5-year extension. So ENS was created in June 2018. So as we know, split share funds all have termination dates. Nothing to be afraid of, guys. It's because of that preferred share. It acts like a bond. They have to put a termination date. That's all it is. It's not because they're going to terminate the fund. They usually just renew it. I have not seen any terminated split fund yet. Okay, so ENS, yeah, it's trading at a premium because it's worth 14.43. You got to pay 15.26. It's not a really big premium. So but like my YouTube short, ENS is completely destroying Enbridge stock. So it's beating it by over 2.8% annualized in terms of total return, which means that if you would have invested in Enbridge stock and ENS at the same time in mid 2018, 5 years or until now, you would have had a 12.5% average total return with ENS, and with ENB, I don't know by heart, but it's 2.8%. Less than that. So 12.5 minus 2.8, it's I think in 9.7. So 9.7, which means ENS is beating Enbridge, which of course is, you know, completely logical because it's just Enbridge shares with leverage, right? Leverage exposure. So yeah, the RS is definitely very interesting this month. Then you have Bitcoin and Ether, which have, you know, big pop in the last 30 days here. Very exciting. So yeah, I mean, what could I say? I do own both of these, Bitcoin and Ether. I know a lot of you disagree with me, and that's completely fine. If you don't understand it, you don't care about it, stay away from it. And if you do invest in it, my opinion is make it a very small secondary position. Me personally, not ever more than 10% overall. There's the new purpose yield share ETFs. Of course, Tesla is the most popular one. I have 5K in this one. I actually, for once in my life, got good timing. So, you know, 2 dividends declared for this one. I'm probably not going to be covering them every month because I want to keep it more broad during the monthly picks, but I am waiting for Purpose to be ready so I could interview the fund managers here. I'll probably speak to Nawan again, so I could talk to them and really ask them more questions about the you know, the covered call strategy that they're going to do. But they have 5 so far, and I know for a fact that there's more coming. So right now you have the Google, Apple, Amazon, Berkshire, and of course the highest yielding one is the Tesla one because Tesla shares are very volatile. Don't forget that volatility makes the covered call premiums richer. So in terms of overall, guys, the sector that still stands out to me and that's already hot and recovering is the tech sector. So in case you missed it, make sure to check out this video here, Is Tech Dead, where I go over on both the Canadian and US stock market, the top income-oriented technology-focused ETFs. That's where I'll discuss things like HTA and HTA, QQCC, TXF. So I don't want to go over it here because I want you to check out that video. It's all there in detail. So definitely, if you ask me, the most interesting thing would be technology again, which you have your choices. If you want to go pure, check out that video to really focus on technology. But if you want something more broad that has a lot of technology, it's of course HYLD, which is very heavy on the technology. But so is HDIV, by the way. pretty heavy, so it's another good choice. We see here 22% technology, but most diversified of the all-in-ones. Even BMAX will have a lot of technology. So technology is the sector I'm watching, and real estate. Real estate might be picking up soon, and you guys know that I like RS. Now let's move on to the American stock market. All right, the American stock market, of course, we're going to start with the big five: QYLD, RYLD, XYLD, JEPI, and JEPQ, my top 5 favorite covered call ETFs on the American stock market, which are all in H yield, by the way. So QYLD, the latest distribution had a nice bump to it. So yeah, the distributions pretty much follow, this is what QYLD, RYLD, and XYLD does. It's, it's just how the fund is set up. They try to give pretty much 1% of the net asset value out a month. So if QYLD stock price starts going down, well, then the dividend should go down as well. But it's starting to pick up. You could see 16.1, 16.4 down to 16.1, and then the latest one is 16.96. So I like QYLD, RYLD, XYLD. I will always like them. They're doing exactly what they've been designed to do. So both, all three of them, QYLD, RYLD, and XYLD, the dividend has increased slightly from the last month. You see 18.7, 19.5. So it's very encouraging. Besides that, not really anything crazy to talk about. These are just boring index-based covered call ETFs, guys. It's not rocket science here. If we look at JEPI and JEPQ, these are a little bit more interesting because the dividends are more, you can't really know what to expect, and it's based on volatility as well. So the JEPI dividends have been really, really high, but you see here that it's the latest one at 44 cents is really the lowest one in a really long time. And this is what I expect. I expect the dividends from JEPI and JEPQ to get lower when volatility goes down or when the stock market is less volatile. So when stock market volatility goes back to normal, I highly doubt JEPI will be cranking out 11, 12% yields. I think it'll be more between 8 and 10, which is completely fine. They have lower fees than the Russell 2000 ones. They're less aggressive with the covered calls, and they're probably a little bit more safer. And a little, you could expect a little bit of growth, but you can't, have both the best of both worlds. So you can expect a little bit lower yields with these ones. And same thing with JEPQ. The distribution you see here, 57, 54, 68, and now it's at 44. So the last one was lower, definitely. So all 5 are doing exactly what they should be doing, guys. Pretty boring. This is, these 5 is really foundational stuff if you're an American income-oriented investor. Moving on to the other ETFs that I like. These are the ones I would consider the best secondary positions to have. Of course, you have SVOL. I absolutely love this ETF. I don't know why it gets such a bad rap, or brokers don't like it. I actually spoke to a couple today that you're using the Vanguard broker and they don't allow them to buy SVOL or drip it or anything, which is pretty crazy. They say it's too risky. That's pretty crazy if you ask me. So SVOL has been performing like a champ. Their latest distribution is back to their 32 cents. So it was a little bit bigger in December, but now their first one for 2023 is back to 32 cents. And I expect a consistent 32 cents. In case you missed it, I do talk with the fund manager again with SVOL. So they are aiming to always do it at 32 cents to keep it nice and steady. So very, very unique. Really nice high total return since inception, but you can't really pay attention to this because it's a relatively new fund, but definitely one of my favorite second positions. Another great option for secondary position would be the newer, well, they've been out for 5 months now, fixed income iShares covered call ETF. So we have TLTW, which is the most boring one, covered calls on government bonds. LQTW, covered calls on investment grade corporate bonds, so safe corporate bonds or highly rated ones. And then you have the one I like, which is covered calls on just regular high yield corporate bonds. So I keep getting, every time a dividend comes out, to be honest with you, I keep getting more and more impressed of how rich the premiums on these fixed income ETFs are. And you see the latest one just came out here, 57 cents for the one I have here, the one I personally own. But LQD, wow, did not disappoint this month, 60 cents. And then you have the government one, which is probably you're gonna have the lowest premiums because they're actually out of the money calls, whereas the other two do at the money calls, 46, so a little bit lower than last month. But all 3 have phenomenal yields of like 15% plus, guys. It's very, very impressive. So I'm just gonna keep watching these, and it seems to me like, hey, it's iShares, the management fee is low, the assets are very, very conservative. So these would make a really good secondary position, in my opinion, in your portfolio. It's up to you which out of the three you choose. If you like all three, combination of the three, but all of them are growing slow and steady. This one's at 16 million, 17 million, and the government one probably the highest. Yeah, at 50 million. Yeah, definitely the most popular one. Moving on to closed-end funds. Now, of course, we're going to talk about the most controversial one first, CLM. CLM is trading at a 20% premium. So in my opinion, as soon as you hit that 20 plus range or premium, it's not worth it anymore. Under 20, it starts to get more interesting. So CLM, nothing really to report here. It's not as attractive as it could be. And remember that I am personally waiting for April and May, because that is typically when CLM does their offering or their rights offering, which usually puts a lot of pressure on the stock price, which means the premium to discount will narrow, which means it will be probably a good time to pick it up in 2 months. So I would hold off and wait for CLM. When it comes to the all-in-one closed-end fund solutions, you have your basic option, YYY, which is an Amplify ETF. Nothing to report here. Their new dividend came out and it's still 12 cents. A little bit of shuffle with their closed-end fund. So in case you don't know what this is, it's just an ETF that holds 45 of the top closed-end funds in the US. So US has a big closed-end fund market. Instead of picking and choosing closed-end funds, you could just invest in one of the three all-in-one options, YYY being the most basic, RIV being your middle one, which is the one I own and what I like. RIV is actually not an ETF. It's a closed-end fund that holds other closed-end funds. And right now it's trading at a 3% discount. So it's worth $12.90. You could pick it up for less than that. So always very interesting. RIV, I really like this one. I'm going to hold it forever and drip it forever in my wife's RSP account. Well, not drip it forever, but drip it for the next 10 years at least. And then, of course, you have your most aggressive and most risky option, CEFD, which is an ETN, so a little bit more risk, which has about over 100 closed-end funds in it. So very diversified. I've been very impressed with CEFD because closed-end funds, which are very fixed income oriented, will turn around eventually because the interest rates are going up. So that usually helps fixed income. So as these funds cycle out of the older bonds or mortgage-backed securities into the newer higher yield ones, you could expect them to go up. And they're starting to go up. So CEFD is going up in tandem. If you follow YYY, RIV, and CEFD, they kind of do the same thing, but CEFD is going to be your most volatile one because they use 50% leverage. So I did say on the Canadian side, it is a good time to buy real estate. I think the two sectors that are undervalued in February this month is tech, again, of course, and real estate. And when it comes to real estate on the US stock market, my go-to is the Brookfield Real Assets Income Fund. So this is a closed-end fund, guys. And right now it is trading at a premium, but it's only 11.45% premium. You could buy it for 18, it's worth 16, 15. So you do have to pay a premium for it, but the yield is over 13%. So in my opinion, this is my favorite fund when it comes to real estate and real assets in America. But again, this is a single closed-end fund, which is in CEFD, by the way, just one of the hundreds of them, but a little bit higher risk because it is a single closed-end fund. But real assets is a non-risky or less risky, rather, asset class. So again, for technology, which is the sector that I feel, technology and real estate, that's undervalued this month still, although technology is already starting to pick up a little bit. Make sure to watch my latest video here, Is Tech Dead, where I go over the top technology-focused, income-oriented covered call ETFs on both the Canadian market and the US market. And there's some new options. Global X unveiled a new technology covered call ETF. So I unveiled those options in this video. So make sure to check it out. So there you have it. That's the American stock market in terms of high yield funds this month. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left hand side there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, and this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors, so make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting, so make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.